Hello audiences, welcome again to Macro and Market Moves at Emkay Global. Today we have Mr. Seshadri Sen, who is the Strategist and Head of Research at Emkay Global. Last when we spoke to him, he was one of the bullish person in the market looking at a 26k target on Nifty, which we are already there almost. And he continues to be on his bullish stance till now. Let's see what he thinks about the market from here and various pockets which could contribute to this journey going forward. Hi Seshadri, hope you're doing well.
Very good, thank you.
Okay, so let's start our conversation 3 to 4 months back when there were too many issues on tariffs and uncertainties around currency and what US does with India. You still remain positive on the Indian market, especially the Smith space. What's your call now? Although there has not much change in terms of tariffs, they are still into conversation. So how would you look at the Indian markets right now?
Thank you, Deepa. We remain constructive on the Indian markets. At the core factor underpinning our bullishness on India is our expectation of a strong economic revival from the second half of FY26, led by the consumption sector. The consumption sector has seen 3 or 4 large changes and stimuli over the last 12 months. We started with the change in fiscal policy of the government from middle of last year, when state governments started to increase their welfare spending, mainly in the form of monthly stipends to women in a number of states.
Sure.
This was followed by the tax cut that came in the FY26 union budget. Any income below 12 lakhs was made virtually tax-free.
Yeah.
Then from January of 2025, the RBI embarked on an aggressive easing plan. This was not just cutting interest rates and injecting liquidity, but this was also a strong element of deregulation there. If you remember, throughout calendar 24, the RBI had, in fearing a bubble in asset quality on the retail side, tightened lending norms across the board, from risk weights to LDR ratios. All of that was unwound, and in fact, where we end up, we are even better off than where we were before the RBI became tightening, because on the corporate side, we've seen some significant changes as well as far as regulation is concerned. So combination of this, and finally, of course, came the game-changing GST cut, which was announced in August and implemented in September this year. So if you combine all 4 of these, we are seeing a very powerful stimulus coming through in consumption. We've already seen 25 to 30% growth in many large value categories like autos during the festival season.
Sure.
Moreover, some of the signs, for example, after almost half a decade or more, entry-level cars are starting to come back into the. So these point to a structural change, and we expect this momentum in consumption to continue through second half FY26 and spill over into FY27 as well.
Sure. So let's relook at the things which have happened in the past, which you just highlighted. One, a lot of monetary policy easing, regulatory easing, thrust through consumption stimulus, both through income tax and indirect taxes, GST. Do you think that the fear is more inbuilt in the system, that there is a potential of a very strong growth slowdown, and tariffs could ultimately be more difficult for many sectors, and thus government has changed its direction into such kind of a move and trying to keep the momentum in growth alive?
It's a very good question, and I think you're right that partly the tariff that was imposed by the US was a catalyst for the government to change its policy towards a very aggressive pro-cyclical, pro-growth stance.
Right.
but there were more factors as well. FY24 was, or FY25, was a really poor year for growth, consumption, and that year also because of the elections, even the capex cycle slowed down.
Right.
And as a result, growth, if you look at corporate numbers, turned out to be quite a difficult year across the board. And on top of that, you had some asset quality worries.
Right.
So I don't think the tariff was the only concern. There was generally a concern about growth and probably a realization that FY25 was a result of over tightening on both fiscal and monetary.
Sure.
But having said that, the worries around tariff was very real.
Right.
While the listed universe was not that affected by tariffs because first of all, exports for the listed universe is relatively small, and the sectors affected have a relatively minute presence in the overall listed space. But from a macro perspective, the tariff, because of two sectors, because of textiles and those are very high employment sectors.
Yes.
Textile, gems and jewelry are very,
which will
which if you
will
don't
impact
pay
the entire
attention to that
consumption
will
pattern.
cascade, and it's not that the listed universe lives in
Yes.
isolation.
Yes.
So yes, I think that was a catalyst, or for the government to push through the GST reform.
Yeah.
Maybe at that point in time, because GST needs to be in consultation with the state government. So the worry about tariffs may have made it easier and more palatable for the state governments to accept it, because in the short term there is a revenue shock they will have to deal with.
Yes.
So the short answer is that yes, tariffs played a role, but there was a larger worry. If you see from the actions that the new RBI governor took in January, I think there was a larger worry about the growth cycle anyway.
Okay. So with all the steps taken by the central bank and the government, do you think India is back on track of its 6.5+% kind of a growth number for FY26 and FY27?
Yes, I think so. More, 7 is probably a bit of a stretch, but I would say 6.5 to 6.75% is the sustainable growth. And yes, I think all these steps will have addressed that, because I don't think the capex cycle is all going anywhere. The capex cycle will also remain fairly steady from here.
Right.
So if you see an upcycle in the consumption on the consumption side, there is going to be growth. The key monitorable there is what happens to tariffs and what is the final outcome. There may be a short-term shock because of that, and which could slow down growth. But again, my feeling is that from a 6 to 9 month perspective, I'm not sure that this tariff regime will stay. I think an agreement will be reached between India and the US, and we will settle down at a much lower rate of tariff. But that is an assumption. Even if you knock that out, I think even without that, we are on a multi-year growth of 6.5 to 6.75. Which is the best outcome. I think is better than doing 7 for 2 years and then falling back to 6.
Sure.
Yeah.
So now, once we have addressed the consumption pull, which needed through taxes, through tax promotion and liquidity flow into the system, and also more or less kind of the worst of the tariff worry is over, let's bring our attention to one of the most important sector, which is financials, which carry the largest weightage in the index as well, where you have been negative from a while. How do you see credit growth coming back into the system and private capex picking up and the key beneficiaries out, both in the financial and the non-financial space for the same?
Okay, I'll answer them question one by one. As far as the financial services BFSI sector is concerned, yes, the operating environment is going to improve, because we think that credit growth, which was very anemic right up to the first half of FY26, is now set to accelerate. We think it ends at about 11% in FY26 and 13.3% in FY27.
Sure.
This will benefit pockets of the BFSI sector, not the entire. If you look at the large banks, they still are a little held back by their own risk appetite and a large base effect. They're struggling to grow at a pace beyond, say, 12 to 13%.
Sure.
The delta in growth will come from the small and mid-cap banks, where we are particularly bullish because one, of a low base, they will be able to grow faster. Many of them will end up at 18 to 20% growth when the cycle gets better. More importantly, they are also deposit constrained banks, so an easy liquidity environment helps them grow. And we are very enthused by the wave of strategic investments that have come into many of these banks from PE funds and
which can bring in some kind of valuation
capital and not only immediate capital but a visibility on future capital as well. So that is one pocket which we think will benefit. State-owned banks are having a great run this year, in FY26, and I think that will sustain. Longer term, my worry is that in FY27 there are no further ROE levers, and therefore, as first with state-owned banks, re-rating is necessary for you to make money, and that re-rating may hit a roadblock if there is no visibility on ROE improvement in FY27. So that's broadly where we are. The larger private sector banks we remain a little cautious on. PSU banks, maybe the second half may see a short-term trade, but thereafter there are challenges in sustaining the ROE. The 2 to 3 year opportunity comes in the small and mid-cap banks.
But you still remain underweight or equal weight now on the sector?
No, we still remain underweight.
Selective small banks.
Didn't mention NBFCs. NBFCs, I think, will benefit, but in many cases the valuations capture the upside. So if you're selective in NBFCs, like in the small and mid-cap banks, you will find some opportunities. But given that the large cap banks don't offer too much opportunity, I still remain underweight on this sector.
Earnings growth was one of the major reasons for our markets not performing compared to all the emerging markets in the previous 1 year. And India was the biggest underperformer out there. How do you see earnings at this point of time, as you addressed one of the largest sector, banking is kind of bottomed out, and you see selective pickup in earnings with small and mid-cap banks? IT is one point of worry. So how would you attribute the earnings going forward from here, and which sectors would lead to the Nifty earnings?
I think, second half of FY26, you will see earnings start to come back fairly strongly. We are likely to end this year in the high single digits again, which is disappointing, but most of the pain will come in the first half. The second half onwards, I'm talking about Nifty earnings growth, should start to come back into double digits from the second half, because there's a low base effect as well, which will kick in. From FY27, the consensus expectation is at about 13 to 15%. We think that now that is highly achievable, because you will see banks which had a slightly weak year come back slightly stronger, because most of the NIM compression was faced in this year. Next year, NIMs will normalize. The IT will also show some acceleration in earnings next year, but the main delta will come from consumer discretionary, which we think will have a very strong year in FY27.
What are your thoughts on the IT sector, which is actually marred by both structural and cyclical issues currently? Where do you think that the earnings would bottom out and there would be a case of re-rating again? Or do you think that it's structurally debasing its earlier valuations?
I think that worries that the IT sector is structurally going to be destroyed by AI are overblown. Yes, there will be some challenges which will come through from AI, but by and large, I think AI will also present new opportunities for the Indian IT services companies. What we are currently seeing is more a cyclical downturn in the IT sector. because the US economy is also slightly slowing down, and
Yes.
tariffs have created uncertainty among the corporates who are less investing. If you take a 3-year view, I think AI will create a real strong upswing in client budgets.
Sure.
If many clients will have to invest very heavily to adopt AI.
Right.
Yes, there will be a diversion from maintenance to development as far as their budgets are concerned.
Yeah.
And that, in terms of market share, does affect the Indian IT companies.
Sure.
But that does not mean that they will be totally wiped out. They will get some share of that increasing pie, even if that some of it goes to AI.
Right.
And the current levels of growth that we're seeing in FY25 and first half of FY26, we expect that from somewhere in calendar 26, you will see an upswing in client budgets and overall top line growth for these companies. The way to play the IT sector is to enter when valuations are comfortable.
Right.
Also remember that from the latter part of the last decade, the IT companies structurally changed their capital allocation and paid out most of their profits as dividends.
Sure.
So that forms a bit of a floor for valuations, especially when it approaches the low 20s. So we think that the obituary of the IT sector has been prematurely written, and tactically there will be opportunities.
Right.
At this point of time, valuations are not that comfortable, so we are neutral on the sector.
Sure.
Another last point on the IT sector is that, unlike in the decade of 2010 to 20, it is smaller IT companies which present the more interesting opportunities. Some of them are egregiously valued, agreed, but they are more nimble, they are more agile, and they are able to capture a larger part of what are incremental budgets. So we remain, we are not writing the sector off. We think that tactically one should keep an eye out, especially on some of the smaller companies.
Sure. So we remain kind of neutral-ish on IT, getting a little more positive on banking, still underweight, but selective picks out there. And discretionary is something which we are most positive and look forward for a investment opportunity there. Having said that, let's come back to a very important factor which has impacted the market and also impacts all the sector alike, is the currency from here. So if you see that there have been quite a lot of monetary stimulus which has been done by the central bank, still the entire liquidity has not culminated into the system, because a lot of it is also consumed by RBI's intervention to protect the currency depreciating further. What's your view out there for the currency, and when do you think a more easy liquidity environment would be there for the other sectors?
I think the worst is over for the currency. Sure. We've seen pretty stressful times, largely from sentiment more than, because there hasn't been that kind of material deterioration in the current account deficit, and from most economists and our economist Madhavi also believes that even in a worst case tariff scenario, there is not that much damage to the CAD to warrant this kind of sales. The problem is that capital flows have been very challenging.
Right.
For India.
Right.
I think the worst is over for capital flows as well, because while tariffs have partly played a role in FPIs exiting India, you've also seen a scenario where earnings. So for FPIs, earnings momentum and valuations also play a role.
Right.
Valuations are still stretched. I will not can't argue that India is cheap at this point in time.
Sure.
But the earnings momentum is changing, and the once the earning momentum swings, we think that FPI flows will start to resurrect.
Right.
And the domestic flows are almost a given, especially in a low rate environment where domestic savers have very few opportunities to invest long term in an asset class which will beat inflation,
Right.
equities is the only place to go. Yes, maybe gold has emerged, but at these inflated gold prices, I don't think we will see too much happening
Right.
there as well.
Yeah.
So domestic flows are a given. All you need is the FPI flows selling to start abating, or even if it's fairly small, that will be a great help to both the currency and the market. So
We
think,
did see a little turn coming out there, but
correct, correct, absolutely.
maybe the earnings have to flow in first to see a major change or a delta coming in from those flows. Right?
And you have to remember that FPIs are focused mainly on large caps, where
Right.
the earnings deltas are a little weaker.
Right.
Meaning, so that also plays a bit of role. But I think the worst is over for FPI selling. The worst is over for the currency. The current level is 88, 89. Also, the RBI stepped in and showed serious intent to defend a level of 88, 89, I think, was where they. So that sends a message to the market as well in terms of where you need to go. So now the other question is in terms of liquidity. So if it plays out as we see, then FPI selling, then the RBI may not have to use up so much of its reserves and strain domestic liquidity as well. The only sort of worry for liquidity in the second half would be that the RBI may need to defend a 10-year bond because there is a chance of fiscal slippage. If that happens, you may see some volatility, but the RBI has enough tools. You're seeing CRR coming in the second half of this year. So I don't think that will be, that major a factor, but it's something to keep an eye out on.
Sure. So now, in an environment where we have thrust from the central bank, from the government in terms of tax rationalizations, earnings kind of bottoming, and then seeing a double digit coming in for the next financial year, let's talk about your index targets and the sectors and your topics out there.
So the index target is 28,000 for September 26. We are valuing it at +1 standard deviation, which is about 21 times forward earnings at that point in time. So we still probably have about 7-8% upside. As I've been consistently saying, if the Nifty moves up 7-8%, you will see much greater appreciation in SMID stocks. So that is where I remain quite constructive as well. My top sector overweights are consumer discretionary, is something that I like. That's broadly, my top and most high conviction overweight sector at this point in time. So we are investing. So as far as stocks are concerned, there are three themes that we are particularly bullish on for the longer term. The first is internet, where we think that the internet companies are coming to a maturity level where their disruption is starting to pay off, and many of them are getting into a monetization phase. Some of them have cracked very serious markets as well from a long-term perspective. So we are playing it through Eternal, mainly because we think that quick commerce has a huge addressable market, and we have only scratched a small part of the surface. And we've seen that in internet, the market leader becomes very difficult to dislodge. So we are not that worried on competition. The second is airlines, and we're very constructive on Indigo Airlines for two reasons. One is that we are going to see 2 new airports come in, which will lead to an expansion in overall market volume. And the competition is still struggling. We think Air India will take a couple of more years to stabilize. Akasa is too small to really impact Indigo's market share. So at this market share, Indigo has turned profitable for the last 2-3 years. And the valuations still don't account for that. So we think that over time, Indigo should probably get a valuation of a consumer company rather than an airline. The third theme that we are pushing is EMS. We think that India's share of manufacturing stroke assembly of electronics goods is, I think, about 10% of total imports of electronics goods.
Yeah.
That number will go up as new categories will come in and share of the existing EMS companies in the bill of materials of existing. So in mobiles, expected that 12 to 15% share of BOM will probably go up to 35 to 40 over time.
Right.
So this gives a very long runway of growth. It's also, while it's a low margin business, the criticality is so important that the OEMs are probably will be unwilling to experiment with too many new players.
Sure.
So there are barriers to entry with a high growth,
Right.
which supports the current valuations because it's also, while it's low margin, a very capital efficient and high ROCE business.
Right.
So that is the third theme that we're talking about. We playing that through Dixon.
Not auto and auto ancillaries part of the
And yes,
discussion.
auto and auto ancillaries also remains our
But
top
valuations
of our weight.
have run up.
Yeah, valuation. But yes, I think Maruti and TVS are two stocks that we continue to like.
Right.
Maruti, I think, has a interesting 2-3 years where they are beefing up their SUV portfolio where they've been lacking in the past. And if we are right and there is a resurgence of the small car market, which we think will come because the affordability gap has narrowed significantly because of the GST cut, then Maruti is on very smooth growth surface for the next 3 years.
Sure. So as we understand from our conversation, moving towards the second half of FY26 on a better base, see earnings pick up from here and more constructive on the markets. It remains to see that how the flows turn out from here and maybe a better agreement on the tariffs. But by and large, constructive outlook for the market for the coming 1.5 years, right?
Absolutely.
Thank you, Seshadri. That was a very interesting conversation. I hope our audiences enjoyed the same. Do write to us if you have any questions. Thank you.